Trading of options is becoming more and more popular every day. Many people wonder how they can use options to invest in the stock market and make some additional money. But, what are options? In this video I will show you the basics of call and put options, so you can understand how they work and incorporate them in your trading. This video will cover the basic points. More advanced strategies will come in new videos. Be sure to subscribe and click on the bell button to stay tuned in for new videos. You can also leave a message if you want a specific video. As a reminder, this is just an educational video and not professional advice. This is More Than Value, your channel where we talk about investing, self-development and much more. Now, let's get to it. There are 6 main characteristics of options contracts that you need to understand. The first one is the side of the trade you are in. You can be the buyer or the seller of the option, and in all transactions, there is always a buyer and a seller. We say that you are long if you are the buyer and that you are short if you are the seller. The type of option: it can be a call or a put option. Call options give the buyer the right, but not the obligation, to buy shares. Put options give the buyer the right, but not the obligation, to sell shares. With one contract you control 100 shares. Underlying. This is related to the stock company we want to buy or sell. It can be Tesla, Alphabet or Amazon. There are also other types of options, like options on commodities or ETFs, but we will leave this for another video. Expiry date. All option contracts are defined by the expiry date. This will be the last day when the buyer can exercise his right to buy or sell. If he does nothing, the option will expire, and the seller is released from his obligations. The strike price. This is the price at which the buyer and the seller of the option will exchange the shares if the option is exercised. Premium. This is the money that the buyer of the option pays the seller for the option contract. It does not matter if the option is exercised or not, the seller will always keep the premium. There are many other characteristics that you will need to learn in order to master options, like the Greeks, the difference between European and American options, or how options are priced and marketed. For now, it is sufficient if you understand the concepts in this video. If you look at all of it together, you can be long. 1. Call Tesla, September 17 at $700 by buying this contract for a premium of $5. This option will give you the right to buy 100 shares of Tesla, no later than September 17, and you pay a fixed price of $700 per share. You will pay the premium to the seller and you will have the right to buy the shares before expiration date. When you are buying call options you are expecting the stock price to raise above the strike price. In other words, you are bullish in Tesla. If on the other hand you are the one selling the call option, you will receive the premium from the seller, $5 per share, that you get to keep no matter what. You might be obligated to sell 100 shares of Tesla by September 17 at $700, regardless of the market price of the stock. When you are selling call options you are expecting the price of the underlying to be below the strike price. In other terms, you are bearish this stock. How does it work with put options? The put options gives the buyer the right to sell shares at the strike price, and the seller the obligation to buy. Let's say you are buying one put contract for Tesla. This will give you the right to sell 100 shares at the strike price. You will need to pay a premium to the seller, say $5 per share. A typical example of someone who is buying put contracts is a person who already has shares in Tesla, but it is afraid that they might drop in price. This person could buy a put contract, like an insurance, so if Tesla drops to $200, he will be able to sell the shares at the strike price. The seller of put contracts is, on the other hand, hoping that the price of the shares will remain the same or rise in price. If that happens, he will keep the complete premium. Risk and reward. When you are trading options, it is a must that you never forget that options can leverage your investment. This means that you can control a bigger number of shares and have a bigger potential reward. But you are also assuming more risk. It is a must that you understand the risk and reward profile of your trade. Let's go back to our original example with Tesla. Assume that Tesla is trading today at $700, and we are looking at call and put options with strike price of $700, premium of $5 and expiry date September 17. If you are buying the call option, your maximum loss will be the $5 you paid for the premium. Your maximum reward is infinite, since there is no limit for how high Tesla stock can rise. If you are buying a put option, your maximum loss will be again the $5 you paid for the premium. You will get your maximum reward if Tesla shares go to zero, since you will be able to buy them for $0 and sell them for $700. Your maximum reward will be then $700 minus the premium paid, $5, $695 per share or $695,000 for each contract. When you sell a call option, your maximum reward will be the premium received, $5. Your maximum loss will happen if the stock goes to zero. You will lose $700 minus the premium received, $695 per share or $695,000 for each contract. And last, if you sell a put contract, your maximum reward will be $5 from the premium received, and your maximum loss is infinite since you might be forced to buy the stock at a very high price and sell it for $700. There are many ways for you to limit your exposure to these infinite losses, and we will cover that in the advanced trading strategies. So, in summary, options are a great tool to invest in the stock market. They offer the possibility to invest whether you are bullish, bearish or neutral. In this video we have only covered the buy and sell of simple call and put options. There are many other intermediate and advanced strategies, where you can combine the sell and purchase of call and put options. I will release new videos with more strategies, together with other that will help you to build a safe passive income, so remember to subscribe and hit the bell button. If, in the meantime, you want to do some reading of your own, there are great sources of information available. My favorite are the CBOE online courses. You will find a link in the description. These are free courses covering all you need to know about options, and they include some tests so you can check your learning. If you prefer written material, you can buy Options as a Strategic Investment from Lawrence G. McMillan. I consider this book to be the Options Bible. And if you want to become a successful options investor, this book is a must in your library. Until the next time, thanks for watching.